Good afternoon. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange. On the call today, we've got Patricio Alvarez joining from his normal perch in Madrid. Good to see you, Patricio. And then swinging over to London, we've got Alessio Mastrandrea joining to chat about the future of energy. Just looking at the screen today, it looks like Brent crude is at $84 a barrel. Natural gas is, at least Henry Hub's, in $2.50 per MMBTU range, and European gas is a little over 30 euros per megawatt hour, which is quite high when compared with Henry Hub. There is a bit of news out on the wire this morning about ConocoPhillips and Marathon. Make sure that you go read Vince Piazza's React on those companies. Reacts are our rapid fire, first take on history. And Vince will actually be joining us next week to share more about his thoughts on the latest M&A activity in the U.S. oil patch, something he's been talking about pretty regularly. Again, he'll be joining us next week alongside, I believe we're going to have Talon on next week to talk more on LNG. We'll have Will Hares on also next week. And then the following week, we're going to have Nathan Dean on, who's our political expert based in Washington, D.C., and he's going to join us to talk about how the election this fall and the potential outcome in the U.S. could affect things like energy policy. So today, though, I want to kick off with first Patricio. If you haven't been following it, Patricio, Alessio, myself, João Martins, a few others have been working on the topic that seems to be at the zeitgeist of the moment, looking at how AI could and data centers could affect demand for energy. Some of the numbers out there are quite staggering. And so we've just got a series of notes really slicing this topic from different angles. And so, Patricio, you've got a note out today looking at AI data centers in Europe and particularly the impact it could have on European utilities. So tell us about the findings and kind of how you see this topic unfolding in Europe.
Sure. So I think a good place to start is which is talking about our previous note, our previous report, which was co-authored with yourself, with Rob. So that report suggested that most of the spending in cloud infrastructure will take place in the U.S. Just given that most of the tech hubs are there, the largest companies are headquartered there, demand hubs are there, et cetera, et cetera. So more than 50% of that capex will definitely or most likely be in the U.S. And what that means for European utilities who are exposed or which are exposed to the U.S., it means that there will be more opportunities to sign those long-term power purchase agreements. Why do we think that utilities are poised to gain? Because they will be able to meet rising demand for energy. They are able to deploy sort of rapid build-out solutions such as battery and solar. We think there's space for wind, but wind will probably take a few more years to ramp up, especially in the U.S. This week, we looked into sort of what the European chapter would be, especially for power demand. So I think it's important to note that European power demand is sort of in a different trajectory relative to the U.S. So both have been very weak. So power demand in the U.S. has been stagnant, roughly flat over the past 2 decades. But the situation in Europe is a bit more tepid. In Europe, actually, power demand has been declining at about 1% per year over the past 10 years. That means that energy intensity per capita has been declining, which means that there's a significant amount of innovation and efficiency taking place and displacing those incremental, let's say, volumes of energy demand. Given that GDP has grown slowly at 1 to 2%, so that does suggest that the GDP growth is unattached or detached from energy use. All that said, we think that roughly 10 to 20% of cloud spending could take place in Europe, given that it's an important hub interconnecting the U.S., mainly the West, the U.S. and the Asian markets. And we can see that borne out in several data center hubs here in Europe. Mainly, we talk about the U.K., where I think a good signpost or a good data point is to say that in the UK, actually power demand for data centers is roughly 3% of overall electricity demand, which is almost twice as much as what the average is in the US, for example. So it tells you that there's a tangible impact from data center demand in the UK. We think Germany is a good place as well, given that it's already a data center hub, especially in Frankfurt. And there are a couple of hubs, aside from those that are emerging. Given that there's land availability constraints, we believe that there are other hubs or other opportunities for hubs to emerge. Perhaps I'm not trying to boost Madrid here, but Madrid has cheap power, has more land availability, and we've already seen commitments by companies like Amazon actually committing capex of 16 billion over the next 15 years in Spain. So that's evidence that those type of investments are occurring. And what does that mean for European power demand? We think it's hard to say what shape the mix will take and which will be the largest contributors of incremental power demand. The Repower EU plan envisions an increase of 30% in electricity demand through 2030, which by all accounts seems very ambitious. But this also includes the electrification of mobility, the electrification of heating, and I think data centers is sort of that third pillar that could help cement some of those gains. And overall, given that it's some sort of the home court of European utilities, we do see that sort of feeding into their earnings potential. Also, because we see that allowing or giving more visibility to their expansion plans in power, basically in renewable power generation, with their installed capacity set to almost triple through 2030. So if you think about those assets, those give you high visibility on returns, given that PPAs are 10 to 15 years. They tend to be highly visible on margins, given that wind and solar are zero marginal cost technologies. So overall, we see the data center theme sort of adding credence to the whole idea that electricity demand in Europe is poised to gain over the next several years.
Patricio, one of the issues on this topic is the amount of time it takes to build a new power plant. So, roughly I like to think of nuclear as being, they're sort of the standard you think of when you say how it's 10 years plus, right? And so they're kind of this long dated thing. It requires lots of planning. The government's involved. It's not easy to build nuclear. Now, on the wind and solar side, I think they tend to be on the faster to build. Maybe gas is also in the faster to build mix. But are you hearing anything about interconnection request and permitting delays? Because this is a big issue in the U.S. of power demand is suddenly growing rapidly, and the utilities tend to move slowly. The regulators tend to move slowly, and it's just a challenge to build all the capacity that industry seems to want. So tell me, in Europe, is this a similar theme you're seeing over there?
Yes, that's very much a similar sort of scenario here in Europe. Interconnection queues, which are sort of the time it takes for a new power plant to get connected to the grid, they're taking 4 to 5 years. There are very long queues, depending on the market, even longer. And that's kind of reinforces our thesis that off-grid solutions are the ones that are poised to gain. Mainly solutions that don't need to, like projects that don't need to be interconnected into the main grid. That brings obviously permitting hurdles. It takes longer permitting. It also could face backlash from consumers, as these could strain the grid and ultimately end up in feeding into higher tariffs. So basically, ratepayers need to pay for these improvements and interconnections. So this is why we think off-grid solutions of battery and solar, which are the ones that are fastest to build, face the lowest hurdles in terms of permitting and also build out. I think those are that kind of explains why we think battery and solar are sort of in a good place to match that demand. Given the pace that tech companies will want to go in building out these data centers, these are the easiest one, the fastest ones, probably solar and battery, but there may be some space for natural gas-fired generation as well, although we do know that the potential in the U.S. Seems to be a lot bigger on that front, and that's mainly because of what you just mentioned at the start of the call. European gas prices are nearly 3 to 4 times what they are in the U.S. So from an economical standpoint, it wouldn't make too much sense to power data centers in Europe with gas from that standpoint, and also it would tend to face higher sort of climate scrutiny or environmental scrutiny here in Europe, given that there's also a carbon market, right? So carbon allowance permits will make it even more expensive to fire up those plants.
Yeah, so one of the things we're seeing here in the U.S., and we'll get Talon Custer to come on and talk about it because he covers some of the midstream names here, but whether it's Kinder Morgan, Energy Transfer Partners on down the line, they're all talking about this theme as well, and they're actually talking not just about the potential boost to power demand and what it could mean for gas-fired generation, but direct connection to the data centers as a source of backup power. We're seeing all of these things kind of sprinting ahead in the U.S. And so, Alessio and I have identified companies here that potentially could see more robust demand growth as a result of this data center theme. And so really building on what you were just saying, Patricio, if you've got sort of First Solar, a company like Meyer Burger, which is actually a European company that makes modules but is really building out its manufacturing footprint in the U.S. Any company that has a battery backup offering, these are the kinds of things that we think could move most quickly. So, Alessio, help us frame kind of what the space looks like in the U.S. around this theme. And I'm particularly curious about a company like Meyer Burger, how they fit into it.
Yeah, sure. So I think last week you really highlighted how First Solar is at the forefront of this. They've got 80 gigawatts of backlog, and it seems like they're going to really push ahead and be kind of the flag bearer for the AI push. But I do think there's potential for Meyer Burger. So a couple weeks ago, they produced their first solar panels out of the U.S., the made in the U.S. panels. That was a big hurdle for them to cross. They did their equity offering, so now they're kind of starting to get on more stable footing with U.S. growth and manufacturing. They've got their offtake agreements with D.E. Shaw, Renewable Investments, and then Inca, which is the parent company of IKEA. But once they kind of get this capacity, I think they're targeting 2 gigawatts this year. Once they get that ramped up, something that they could look into is definitely powering some of these AI data centers, and I think they've mentioned that on their calls.
Are you worried about the risk that the U.S. election poses for some of these companies? And so, if for anyone who's not aware, there has been an incredible boom in manufacturing taking place around the supply chain, particularly for solar and batteries in the U.S. And so First Solar, factory expansions in Ohio, but also Alabama, Louisiana. I can't recall where Meyer Burger's locations are off the top of my head. I know Canadian Solar also has manufacturing under construction or identified where they want to go. Hanwha, which is a Korean manufacturer, facilities being built in Georgia. So how does all of this build out fit into the political discussion in the U.S.?
I mean, it's definitely something front of mind heading into November in the election cycle. Like, no matter who wins, I hope they kind of see US-based manufacturing as something that's for energy security rather than trying to compete with the price gouging that's going on maybe in regions like China. So we kind of did an analysis on how many factories were built in the US for wind and solar production since the Inflation Reduction Act came to be. And it's about 50-50 split between red states and blue states. So hoping kind of cooler heads prevail, and this is seen as a bipartisan thing where, you know, we've got the energy security build out incoming, but also some job security.
Yeah, these are pretty interesting how the political map looks, and I do think it'll be great in a couple of weeks to have Nathan Dean on to offer some more context. I will tell you that the way he kind of thinks about it is, even though this is an election issue that may get some discussion about, you know, whether the IRA stays or goes, he assigns a pretty low probability to an outright repeal of the bill, given there will be lots of other competing priorities. If you think about the previous election, 2016, one of the landmark issues that President Trump was running on was repealing the Affordable Care Act, Obamacare. That didn't happen for a variety of reasons. He kind of sees this perhaps fitting into that same kind of zeitgeist. But we'll keep an eye on it. We're going to go deeper on that topic in the near future. Okay, Patricio, let's swing back around to you. I know you've got an update out on natural gas in Europe. We mentioned where the price was at the start of the call, and you've already insinuated it's still quite a bit higher than over here in the U.S. I don't think our clients need a reminder of what that is, but tell us how you're reading the tea leaves for 2H on gas over in Europe.
Sure. So, natural gas right now is trading almost at 34 euros per megawatt hour. So that's near the top range of what we think European gas prices should average throughout the whole of the year. We think 20 to 35 is sort of the range. So we insinuate a midpoint of 30. At the moment, it is kind of unexpected for European gas prices to be this high, given the sort of the fundamentally bearish signals that we see both in demand and supply. So the global LNG pool is poised to expand by about 3 to 4% this year. And demand in Asia, aside from China, is broadly flat. Demand in China keeps rising, which means that this price reaction is actually probably in result to that price competition with Asia, because right now netbacks in Asia are higher than Europe. So this is mainly the pull that you're seeing in the price. In Europe, gas demand is still roughly 20% below its 2021 levels. There's been some signals of a rebound in May for industrial gas demand, but you're talking low single digits versus a base that is roughly 20% lower than 2021 levels. Overall, we expect demand in the EU27 to recover roughly 1 to 2% on an annual basis, which sounds rather bearish. And on the other front, I think the other sort of big supporter of our view that perhaps European gas prices are a bit too lofty at the moment is that gas storage levels are still at a historical record. They're tracking 1 to 2% ahead year over year, when in 2023 we hit a historical record already, so we're beating that record again. We're very much on track to refill storage, fully refill storage by September, which is more than 2 months ahead of the regulator's target. So overall, the story I think for gas is it looks like it's a bit lofty. There's perhaps some supply risk or some geopolitical risk baked into pricing as well, given that there's been talks that that Russian flows or the residual Russian flows going through via Ukraine will cease sooner than expected. We expected that to come at the end of the year with the end of the transit agreement, but it looks like sort of sanction risk could result in an early cut to those flows. That's roughly 3% of European supply, and also the the regulator or the utility managing that gas has already sort of reaffirmed the market, saying that there's enough LNG to replace those volumes. So that sort of adds to our view that perhaps European gas prices are trading on the lofty side at the moment.
All right, thank you, Patricio. There is a question in the chat about the contracts for non-interruptible power and gas. I think we'll punt on that question and revisit it when we get Talon on. But what I would say is, if you look at the data center gas opportunity in the U.S., I think it's a pretty critical part of the overall thesis on gas. It's probably second place after LNG. So LNG is a big part of the U.S. gas narrative, much of that going over to Europe, as Patricio was just talking about. And when you look at some of the companies, there's a range, but many of them are talking about data centers adding around 7 BCF per day to 10 plus BCF per day of gas demand by 2030. And, roughly we're talking 100 BCF per day type of market, right? So this is a pretty big incremental boost if some of these things unfold how certainly the companies are hoping, and it's certainly how we're seeing some of the AI data spend imply. Now, Alessio, I want to come to you and get some perspective on the wind market. So one of the things that I think particularly in Europe that's a factor for kind of how you think about that trajectory of overall gas demand is European policymakers are really trying to drive as many non-emitting electrons onto the grid as possible. It's not just a solar story, it's also a wind story. Yet at the same time, I've seen some pretty challenging headlines in the last couple of days about Siemens Gamesa and continued challenges in their wind operations. Are you seeing similar struggles for Vestas and Nordex? And how's the sort of order flow looking for these companies given some of the push from policymakers?
Yeah, sure. So Vestas had a monster 4Q. They raked in about 7 gigawatts of orders, which was a record for them. Just for context, Nordex did 7 all year last year. Orders slowed down a little bit in Q1. They got about 2.3 gigawatts, but the selling price remains pretty stable. They're about €1 per megawatt, and 2Q orders are already off to a pretty good start from what we're seeing. I think this is signaling that reiterated guidance can be met, if not exceeded. Nordex, on the other hand, doubled orders from 1 to 2 gigawatts, and like I said before, they did 7 last year, and I think they're on pace to top that, just given how historically Q1 is pretty low seasonally. I think the issues at Siemens Gamesa are kind of isolated to them. They had their faulty turbines. They kind of tried to scale up a bit too quickly, and I think these two players can really start to take market share away from it.
Thanks, Alessio. I'm curious, generally, if you could extend some perspective on deliveries across the solar space as well. I know much of the theme that we saw really starting with 2H last year is we saw some really big inventory builds, and we've seen as a result deliveries slow down for everything from modules to inverters. Are we seeing those backlogs of inventory clear yet? And kind of what do you make when you look out into the second half of the year in terms of just deliveries, sales momentum, margin, these kinds of things for the solar space?
Yeah, inventory destocking has been an issue across all residential peers, but I think it really focalized on the inverter players. Enphase was off to an amazing last few years. I think they had a compound annual growth of about 47% top line over the last 5 years every quarter. That kind of changed around 2Q, 3Q last year, and now we're seeing kind of growth really slip. Both Enphase and SolarEdge are seeing that they're under shipping demand by about $250 to $300 million. And in the case of SolarEdge, that would have doubled their sales this past quarter. I think we do start to see this begin to ease in 2Q and then start to return to kind of a bit of a return to growth, just because 3Q, 4Q were very low last year, and then that could kind of trickle into other parts of the space.
I'm curious, one of the few solar exposed manufacturers that's in Europe at the moment is SMA, which makes inverters. So Meyer Burger, European company, but it's sort of transitioning almost to a U.S. company almost. What about SMA? How are they handling all of this? Where do you think about them in the mix versus Enphase and SolarEdge?
Yeah, so SMA, while Enphase and SolarEdge were having these booming years, they had a bit of like a supply chain issue that really hit them harder than the other two players. But now the roles are kind of reversed. So Enphase and SolarEdge are more on the residential side. SMA really dug down into the commercial side, and they're seeing growth and consistent margins, and they actually ship even more than both players combined, both other U.S. peers combined.
Okay, thanks. Patricio, let's come back around to you for kind of final comment. Similar to what we were just hearing from Alessio, there's some green shoots in the wind and solar space. There's some challenges, depending on kind of which names you're looking at. Tell me, on the sort of gas and utility world, how do you kind of frame the sort of relative performance across different types of players in the value chain right now?
Oh, sure. So I think, utilities are good at anticipating sort of what their earnings could be when they disclose their investment plans. They tend to disclose every other year. They tend to give out the 3 to 5 year spending plan, and this is something that we started to see late in 2022. Companies like Iberdrola, which is the largest diversified utility in the stock 600, that company started pivoting away from the expansion of renewable power assets and pivoting into a higher allocation into grid investments. And I think that trend has been borne out, has been replicated by other players in the same vein. So you see Enel, which is another diversified utility, investing a larger portion of its spending in grids, and that's mainly, I think, because there's this cycle in the market of higher for longer rates. Grid investments tend to be indexed to inflation and protected from higher interest rates. So these companies, the companies that are sort of in the regulated space, so you're talking about your power, your power grid utilities, so you're talking about E.ON as well, and Terna. These are the companies that have been performing, I think, relatively better than other sort of more cyclically exposed utilities. So you're talking about independent power producers like in Germany, RWE, which is a company that we closely follow. That company has a large position in thermal power, so they do a lot of gas-fired and lignite-fired power. Their earnings have been impacted significantly because of this deflationary trend that we've seen both in gas and power and carbon. So for us, I think that's the deciding factor. Like you said, the landscape of higher for longer rates mean that we have to be more selective in terms of the stocks we look at. And at the moment, we still like integrated utilities. Integrated utilities are the ones that have a bit of both, have renewable assets and also power generation and also grids. So those are the companies that we like because they have sort of a stable income via grids, and also they have sort of what we think in the long run will be exposure to incremental earnings via an expanding renewable asset base.
All right, we'll have to make that our last word. Thank you so much, Patricio and Alessio. Just a quick bit of advertising. If you're based in New York, next Thursday we have an in-person roundtable. Myself, Will Hares, Vince Piazza, Talon Cusser, Scott Levine, and Brett Gibbs will be there. We'll talk about all of these kind of topics, and we'll go have a drink afterwards. So shoot me an IB or an email if you want more info on that. It's pretty easy to find on the terminal as well. So register, come say hello to us. And then again, next week, we're going to have Vince on, who can talk about this ConocoPhillips marathon news that was on the wire this morning. And then the following week, we got Nathan Dean on. So look forward to being in touch, whether on these calls or in person in New York next week. So I hope you have a great remainder of your week, and thanks you for your time today. Take care, everyone.